Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Hit that like button if you already haven't, and subscribe. I decided to do another video today. I just want to thank my last video. I more than doubled my subscriber count. Not my last, but my second to last. So just want to welcome all those new subscribers. Thank you very much for subscribing. I hope you continue to like my work. The first thing I want to get into is the commercial real estate bubble. And I can't see how it can't be any more apparent. And what's going to follow from this is a banking crisis. So we'll get into that. And so first thing is, I was looking at New York Community Bank. And just real quick, this is the Wall Street Journal. New York Community Bank said it set aside $552 million for future potential loan losses, largely from commercial real estate, up from $62 million in the third quarter. Now that's a big jump. And Reuters has a thing, real estate pain for regional banks is piling up. And this is what's really hurting the community and regional banks is these commercial real estate. Now, Wall Street Journal is behind a paywall, so I couldn't really read too much, but there's also Tokyo-based Ozora Bank. Sorry, I don't know how to pronounce it, but they've also suffered. And I'll link the article if you have any way to read it. I can't read it too much. But yeah, and it says commercial property losses hammer banks on 3 continents. And a lot of these are interest rates. I mean, a lot of people can say work from home. I think that is one of the reasons. But I also think the economy is just horrible. They're trying to do everything they can to bring people back to the office. I don't think that will fix it. And it's not just the regional banks. There's another one, Arbor Realty Trust. They even said they're having deep trouble over multi-family lending. And I was looking at this, and it says Arbor Realty Trust has long been a prominent player in multi-family lending, but the firm's heavy exposure in the industry and its reliance on floating rate has landed into trouble. And this one is more multi-family syndicators. This is Arbor name of itself in recent years by providing floating bridge loans rate to multi-family syndicators. These syndicators, many of them inexperienced, focused on buying transitional properties that needed renovations and rehabilitations, after which they could increase rents. The problem is they weren't listening to this channel. The real economy, most Americans live paycheck to paycheck. They don't have the power to increase rents because Americans can't afford it. Instead, at 0% interest rate, it's hard to lose money doing that. Well, yeah, that's because when you buy these properties at 0%, it pushes inflation, the values of the property go up. So even if you don't get renters, the greater fool will buy it, and you'll still have equity and you'll be able to sell it. But the problem with these bridging loans is that substantially all of them are floating rate. Yeah, a lot of people locked in 0% interest rates, but and it said rising interest rates have left syndicators underwater. So you can read more about it. I mean, I know what they're saying. Like, they're sort of framing it from what I saw in the article that these weren't safe. They were just rogue. But people don't realize that that's what a bubble does. It's always the weakest legs that are taken out first. Like during the housing crisis, subprime loans. Those were the weakest, and those were taken out first. And that's why they said it's a small blimp, but it's a tiny blimp. Ben Stein and Peter Schiff argued, and they said this is contained. What people don't realize, they always say that's just one out, or they're just crap, or sort of a classist thing. They're saying, oh, there's no problems. They're just bad, bad actors, but the nature of bubbles is it's always, I'm just using '08 as an example. It's the weakest that take out, and then there's a waterfall effect. And I think residential real estate will follow, but it's not there yet. And I'm going to prove one more article, London Now. And right here, it is Dulles Town Center in Loudoun, Virginia. So to show this isn't just really bad, this is how I say I check with a lot of different things. I check a lot of different sources. There's going to be 2 orders. It says Dulles Town Center in Sterling sold for $46 million, which sounds like a lot of money. It's commercial real estate, it's mall. But if you go look at the past, this property in 2008, this is in the heart of the housing crisis. The heart of the housing crisis was valued at $300 million. And then in 2018, this was assessed at $183.6 million. And then the recording of the foreclosure was $55 million. And then it finally sold for $46 million. So you can tell this is the richest county, not just in Virginia, the Mid-Atlantic, or the East Coast. This is the richest county in the United States of America, where commercial real estate valued at $300 million during the heart of the housing crisis in 2008 were sold for $46 million. And you can tell by New York City Corps, they've set aside $552 million for future potential losses, up from $62 million in the third quarter. They say fourth quarter losses stem from 2 properties, including 1 office loan that went bad after an updated valuation in the third quarter. So that's what I want to get into. Is I'm just showing you that this commercial real estate, I think the bubble's popping now. And it's not just like the Arbor Realty Trust, which I'll have all these articles below. This is a thing that's happening now. The other thing I wanted to get into a couple of things, is I saw this article today, 2025 City Analysts Don't Rule It Out. And it says gold at 3,000, oil at 100. And if you actually look at it, now I do agree. I think sometime this decade, you can tell it's clickbaity because I'm a gold bug. I love gold. I think everyone should have it. I think 10% of your portfolio should always be in physical gold. And I think gold's going to set up on another upswing. Now, my target's like 2,500 to 2,800. I know, and I think the miners will double. And then I plan on taking some profits. And central bank gold rush. This just goes to show most experts in the finance realm don't know anything about gold. They say central banks gold rush. And they said this wild card, de-dollarization across emerging markets, that's going to push up, they said, could double central banks' purchases and push gold up to 3,000. Now, central banks are buying gold rapidly. This CNBC City thing, I was like, am I watching Zero Hedge? And I'll tell you this, central bank buying does not indicate any reason. Central bank activity does not dictate gold price. A lot of it is real interest rates in the economy. Central banks, the brown bottom was one example where they sold huge amounts of gold. And what happened? Gold went up. Another one was, I still remember this because I was around for the gold bull market and the bear market. And I remember in 2013, all I heard about China, India, all these central banks were buying gold at record price. Gold went from 1900 to 1000. And this, it's not what drives it. It is real interest rates, bad economy. If you listen to my channel, it is low interest rates because the economy is bad and the Fed has to ease because of a bad economy. That's what pushes gold. That's why gold hasn't broken out. That's why 2015 bottom around 1,000, went up to 1,300, sort of petered out. Because when the economy's strong, they'll go into the Magnificent Seven or the Fantastic Four. I don't know what it is. Tesla's sort of maybe the Fab Five, or the Sexy Six. I don't know what it's called now. But it says that means the brakes have been cut. I'm just reading from this article. Not the 3%, but the 1% or lower, and that will take us to 3,000. And it says, as interest rates dip, gold becomes more appealing compared to fixed assets such as bonds, which would yield weaker returns in a low interest rate environment. Low interest rates don't always, it has to be low real rates and a weak economy. And I think we're getting to that. Because if you look at 2019, 2020, anytime there's a perceived strong economy, the gold peters out. But it says Citi maintains that their base case for gold is 2,150 for the second half of 2024, and the price of gold will average over 2,000. A new record could be reached towards the end of 2024. And that's what it says. It says, it's clickbaity, but the last paragraph so they're trying to get all the gold bugs, and if gold goes up to 3,000, they'll say we called it. If it doesn't go there, they're going to say, see, well, if you read the article, we said our base case was 21,500 or 22,150. Sorry. So of course it got into oil, and it's a catalyst, geopolitical risk, deeper OPEC cuts, supply distributions. Oil's similar. It needs lower interest rates. There's demand metrics to it. But yeah, I think war will drive oil up. And I think that we are at war right now. Meaning the United States. It's covertly, but they're at war. Will they be in a hot war? I don't know anytime soon. But yeah, that's the thing. I do think gold is going to go on a run. I think it will start later this year when the Fed is forced to cut rates. But right now, if you look at it, the data, for the most part, looks strong. There was a really... now, don't get me wrong. I don't think it's real. I don't think the data reflects reality. But the markets care about it. But I think gold is going to go up. I think they'll eventually have to cut and bad data. And so I think gold's going to go up. And then I think once it gets to somewhere between 25 or 2,700, maybe even notch below 3,000, then there'll be deflation, a really bad economy. And that's how it looks like to me. So anyway, that's all I have. I was going to talk about more. I will save that for next video. I will post the links in these articles. And if you listened all the way this far, hit that like button, subscribe if you already haven't. I'll see you next video.